On 7th January 1999, in the midst of the dot-com boom, Raven, a chimpanzee, threw 10 darts at a dartboard of 133 internet-related companies. As the chimpanzee did not have any prior knowledge of how any particular internet-related companies have been performing, they took his 10 picks and dated the price back to the beginning of the year so as to provide an easier year-to-date comparison with the traditional indexes such as the S&P 500 in the United States, which is a stock market index that tracks 500 publicly traded domestic companies. Wall Street thought that the chimpanzee had talents far beyond what they could ever dream possible by the stock picks that he had made. They even launched a special website named monkeydex.com, which served as an index to monitor the progress of Raven's stock picks. The monkey created a storm with the stock picks like CMGI, which went up a whopping 95% in just 6 trading days. Raven, the 6-year-old chimpanzee, became the 22nd most successful money manager in the US after choosing her stocks just by randomly throwing darts at a list of 133 internet companies. In 1999, the chimpanzee's stocks delivered a whopping 213% gain, outperforming more than 6,000 professional brokers on Wall Street. He even earned a spot in the Guinness World Records as the most successful chimp on the Wall Street. But unfortunately for Raven, his success and eventual bankruptcy were simple products of time. His investment career began and ended with the dot-com boom. In August 2000, 1 year and 8 months after the dartboard experiment, the MonkeyDex was down 34%, during which the Nasdaq was reportedly up 3.37% for the year. From then and there, things got even worse, and not just for the chimp. Overall, Nasdaq crashed nearly 70% between 2000 and 2002, representing trillions of dollars lost, and bursting one of history's most spectacular stock market bubbles, the dot-com bubble. Every single stock picked by Raven back then is worth nothing today, not even a single penny. Each of the firms facing collapse in some form or the other, be it basic bankruptcy or a fraud. Turns out, tech stocks were simply so popular back then that short-term gains were as easy as training a chimp to throw darts. But whatever success Raven found quickly vanished when the internet trend turned its tide. Most people start trading in the markets, lured by the idea of making easy money. But anyone with some experience will agree that the stock markets are probably one of the toughest places to make money. If you like it or not, it is the truth. Just think about it. You need to have a decent enough strategy, and it needs to keep upgrading and evolving over time in order to stay profitable over different market cycles and hundreds of trades. Anybody can make money in a strong bullish market. We have seen this with our own eyes. We have seen a lot of people emerge victorious after the unbelievable bull rally that the market gave after the coronavirus crash. But what happens afterwards, when the market decides to unveil its real face? Will most of them be able to survive, or will they vanish just like Raven the chimp? Trading is like an India-Pakistan cricket match. During each match, we experience the fear of losing, the joy of performing, and the pride of winning. Similarly, each trade is a test of your emotions. You need to keep your greed, fear, and pride in check to ensure you make more on winning trades and lose less when you're wrong. The idea of becoming a successful trader lies in considering your trading more of as a business and not just as an easy option where you can make some extra cash. Trust me, only very few who start trading will likely to continue doing it for a longer term and succeed, just like people starting any other new business venture. To understand it, let's take the case of restaurants, which is actually an easy business to start in terms of the technicalities and other factors. Anyone with some capital can start a food stall and hire a cook and some employees. They might get a good share of customers during the initial days of their open, as more customers would like to try out the food. But for a restaurant to be successful, customer experience, consistent quality, and variety in their menus matters. So for every successful restaurant around you, there are probably 100 of other restaurants who end up shutting down due to the same reason. Similar is the case with traders. For every consistently profitable trader, there are hundreds who go bust and leave the market empty handed. Another reason that makes trading riskier is that it has a very low entry barrier, meaning anyone can get started with trading without even having a prior knowledge or understanding on what's at stake, unlike setting up a business, which is actually a process that requires a lot of time and effort to accomplish. This lack of entry barrier is also the beauty of trading, because there is no discrimination. Anyone above the legal age can participate in the market, irrespective of your educational or financial background. But where people go wrong is in their ability to give themselves time and understand the waters, but rather they just jump onto it without knowing what is about to happen, just to get themselves drowned. So if you are a stock market trader, you will most likely focus on the technicals, fundamentals, or price action aspect, or you rely on brokers or advisors, or even news for your buy or sell signals. But at the end of the day, none of these strategies are foolproof. I have never seen a strategy that works 100% of the time, and I don't think there is any strategy like that. All these strategies and advisors can eventually lose money. The most important aspect of trading is not really the buying or selling, but it is what you do before, during, and after your trade. Because once you take a trade, the movement of the prices are not in your control. All you can do is to predict or forecast with some amount of confidence that the price will do what you think. It can turn out to be true or false. So all you can do is to control how you react with your trading. A very few people in the trading world actually practice this important aspect of trading called the psychology, which is the study of human mindset and emotions and how you can mold your behavior while actively trading in the markets. It is as important as the fundamentals or technicals or price actions or your choice of trainer or advisor. So, in the upcoming episodes, we will see how we can conquer our mindset to understand the different emotions around trading and how we can conquer them in order to trade with a peaceful and calculated mindset. So, if you are excited about the journey, please do like the video and subscribe to the channel, and do not forget to press the bell icon to enable notifications so that you don't miss out on the upcoming episodes.